If you have a conventional mortgage loan on a property, and when you bought that property, the down payment was less than 20% of the purchase price, you're probably paying PMI. Literally throwing money away that you could be using to add equity to your house. But don't worry, there are a few ways where you can remove PMI, and the last one might be the secret weapon when interest rates are high. Hey everyone, Kyle Anderson with Liberty Core Real Estate. Today we're going to look at 3 different ways to eliminate that PMI payment forever. First, let's start with what is PMI. PMI is an acronym for private mortgage insurance. In insurance, you're required to pay either upfront or monthly if you have less than a 20% down payment of the purchase price of a house. Now, this insurance doesn't even cover you as the buyer and homeowner. It covers the lender in case you default or stop making payments on your loan. So let's stop paying an insurance that doesn't even insure you. So the first way, and the most obvious way, pay down your premium so you're above that 20% threshold. So using some simple math, if you bought a $100,000 house, which I don't know if they exist, you would have to invest $20,000 into that house to get to that magic 20%. The trick here is you need to request a cancellation with your lender once you get to that 20%, because the bank won't cancel your PMI until you get to 22%. The drawback here is you need the cash to get there. That brings us to the second way, and that is refinancing. If some time has passed since you purchased a property or you've made some improvements, your home has likely appreciated. This means you have equity that you can use as justification that you have at least 20% invested into the property. One upside to this, besides removing the PMI, is if you have more than 20% equity into the house, you might be able to cash some of that money out and put it right back into your pocket. The downside is now that your home is worth more, your mortgage payment is likely to go up, and you'll also have to adjust your loan to the current market interest rates. So not too appealing if interest rates have gone up since you purchased the property. Not to mention, refinancing requires lender fees, just like when you purchased the property initially. So that brings us to number 3. You ready? Getting your home appraised. If your interest rate is much lower than today's interest rates, this one might be your secret weapon. This would be a good time to ask your real estate agent for a comparative market analysis or their opinion of what your home is worth. Figure out the difference of what your home is worth now versus what you paid for it. Add that to whatever you've put towards the principal already. And if that number is over 20%, then go ahead and get an appraisal done so you can have justification in writing. You will have some associated costs like the appraisal itself and possibly a PMI removal fee, but the best part is you get to keep your interest rate. Thanks for watching, everyone. If you have any questions about this, reach out to me or reach out to your lender and let's remove your PMI.